if I sell a property and make 50 grand on it, but I have $40,000 worth of expenses in my business this month, it's not, I don't have to pay taxes on that 50 grand because to me,
Right.
it's a business, right?
What has been your biggest frustration with that capital gains tax or the 1031 as it stands right now?
I've only done one 1031, and I think 1031s are great. I just don't think that I'm really there in my career yet to really take the best advantage of them, because whenever I need to sell a property, I typically need the cash. I need the income. And when you 1031 it, you're deferring taxes, but you don't get the income either. So if you use 1031s, you don't have that income event or that taxable event. So sometimes having the taxable event is needed, but I think 1031s are great. I know people that use them a ton, and they're a great way to defer your taxes. One of the reasons I think 1031s are the most amazing thing is because if you keep deferring your taxes by using 1031s and then you die and you leave the real estate to your family, the basis gets reset to the market value.
Yep.
So the 1031s really, if you take 1031 and you add death on it, it's a flawless strategy to avoid paying taxes. But you got to die for that to work. So if it's something that you're trying to leave a legacy, it's amazing. But if it's just you trying to not pay taxes for you, you can't really avoid that until death. So 1031s are great. When it comes to capital gains on on real estate, obviously you're going to pay less whenever it's a long-term gain. But it can be a little tricky whenever you are a full-time real estate investor and you're buying and selling properties as your main business. Because if I sell a property and make 50 grand on it, but I have $40,000 worth of expenses in my business this month, it's not, I don't have to pay taxes on that 50 grand because to me, it's a business, right? So really what matters at the end of the day is, what is the net income on that month? And then what percentage of that net income was short-term versus long-term? It gets a little complicated when you do this full time. I have to have a CPA help me with all this because it's way over my head, right?
Yeah.
But if you are a passive investor and you're not buying and selling 10 houses a month like I am, then hold the property for 366 days if you can, because your taxes are probably going to be, I don't know, 40 to 50% less, give or take.
Yep. Yeah, definitely. And one of the things you said, I want to just kind of go back and touch on, because I think it was really interesting. And it was, you 1031 up until you die, and then, you can pass on a legacy. And the one thing that I would say to that is that's absolutely true that you do get a stepped up in basis. And I think that that's a phenomenal advantage to a 1031. But if you're over the threshold of 11 million bucks, and or you're married and you have 22 million together, what ends up happening is you get taxed 40% above and beyond that 22 million mark. So if you got a property that's 22 million, that's a 40% death tax on your estate that has absolutely nothing to do with the capital gains tax. And so the 1031 is phenomenal for the capital gains tax, but the elephant in the room, right, is this, now you have this estate tax that you have to deal with if you're over that threshold.
I wasn't aware of that, but I'm glad that I learned that today. So
yeah, so one of the things that we use is so we use a deferred sales trust. And what's unique about the deferred sales trust is that it removes assets outside the taxable estate. So not only do you get to defer the capital gains tax, but you also get to defer the estate tax upon your death, because your heirs can go back in. It also provides you with the ability to cash flow, as opposed to just going right back into a hard asset like a real estate. On top of that, you can reinvest those funds in whatever you want. It's like kind of agnostic. So you don't have to 1031 into, a property. This isn't exact, and there's a lot of, language that's wrong with it, but conceptually, right, it's almost like you can kind of 1031 into a self-directed IRA account and invest in whatever you want without the time constraints either. So you get the power of the timing, you get the tax deferral, you get to move it outside the taxable estate. And it also works for crypto. It works for a business. It works for stocks. It works for commercial real estate. It works for a primary home. It works for appreciated notes. It works for anything. So it's a phenomenal strategy when it comes to
So whenever so what does it consist of to create a trust? I don't have any trusts yet.
So this is a special trust. This is a business trust that you create when you're going to have a liquidity event, right? So if you're going to go and you're going to sell something, I'll give you an example. There's a gentleman. I live out in Newport Beach, luxury realtor out here in Newport Beach. There's a gentleman who bought 2 properties back in '88 and '90 for like total of like $1.2 million. He depreciated everything down to 100%. Property's right on the sand. House is worth $12 million easy. Okay. He's going to sell it. Upon selling that property, okay, those 2 properties, he's going to have about $4 million in capital gains tax alone, just on that. His basis is pretty much zero, and he's got a $12 million gain, 30% of that for probably way more. Depreciation, recapture, and all that. But this guy 1031s, he's in his 80s, right? He's got to go and he's got to hold the asset, and it's got to cash flow and stuff. That's really it. He can only go back into real estate. But if he does a deferred sales trust, he can defer all those $4 million, take all the net proceeds. He can put it into the trust, invest it in super conservative, assets if he wants, cash flow out of it, go back into real estate when he finds a good deal, and he can live off the interest and be totally good to go. Completely.
So you can't pull that out of the trust, though, can he?
Sure, you can pull it out.
Is it taxable at that point?
At that point, yeah, you would get taxed on it. But my question to him is like, what do you want to pull it out for? So what are you going to invest it in, right? What are you going to do with it that is gonna make that you can't do with the trust? Because you can invest in anything like you want with the trust. So the only thing you can't really do is go buy another primary home or whatever. In that case, what we would do is we would just have him do a cash out refi to the amount that he's going to want to, pay the up to his basis. Take out what he wants as a down payment. Go buy a new house with the down payment. Sell the asset, right? Put everything in the trust. The cash flow from the trust, earning a 8%, 9%, 10% is going to be more than the 5.5% to 6% on the note that he's going to pay. So he's going to earn a 4% arbitrage on the difference. And then he can use that income that's coming in from the trust to qualify for a loan. And he has the down payment amount to go ahead and put it down. So now he's pulled out the equity, right? It's cash free, or it's tax free, right? He's using that to put that as a down payment. He's using the interest that he's earning on the note, right, to pay for his mortgage if he wants to do that. Plus, he gets a 4% arbitrage, and he gets to invest it in whatever he wants, whenever he wants, and he gets the entire chunk at the same time.